to last. Okay, well, I think we have as many people as we're going to get for now. People are going to trickle in. That's fine. But we're going to go ahead and get this started. So for those of you who don't know who I am, my name is RPS. I am an institutional trader and investor. I run a hedge fund as well as a private wealth management RIA firm. Joined with me today is Moneylytic. He's going to be working in the background on admin. And then Jaya is here as well. He just exists in our network. We don't really know what to do with him, but we keep him around. Today, we're going to go ahead and go through the intro and very bare bone basics of the market. Lots of you guys ask day in and day out, where to start, what do I do, what is stocks, what is crypto, so on and so forth. So we're going to go ahead and break it all down into some basic concepts, and hopefully you're able to pick up some information and start applying that. How a lot of this works is it's going to be a lot of self-direction and self-directed studying. There is, what are we at now? There's almost 45,000 of you in here. So unfortunately, that doesn't create an environment where we can spend one-on-one time with every single person. Otherwise, we'd be doing this for years to get through everyone. So with that being said, self-dedication and self-directed study is going to be your best friend. There's a large education section down towards the bottom of the server. So starting to watch the videos that are in there are going to be your best bet and a good place to start for you. Outside of that, we are going to start hosting classes every single weekend. May even start doing some here and there during the week and doing little pop-up workshops. We'll see. But the best bet for you to do outside of those classes is to take some self-directed study and then formulate questions from those and then ask the team members. We have an excellent staff, well-trained and educated staff here to help you who have been doing this for several years. So with that being said, how today's class is going to work, I'm going to talk here for about 30 to 45 minutes. We'll see where we're at on time. And then what I want to do from there is drop all of you out into your own breakout rooms with 2-3 other people. So that way you all can chat and talk about what I went over, and you guys can kind of work together in a team environment to start working through the material that I was talking about. Myself, Jaya, and Money, and if some other head traders join today as well, we'll bounce around between those breakout rooms and help answer any questions. But we really want you guys to pay attention, study, take some notes, and discuss amongst yourselves so you can start figuring this out. The only way to truly learn how to do this is to apply it. So by doing that, it's going to make it better for you. So with that being said, let's go ahead and get rolling into it. So many of you are here from TikTok, looking from the chart patterns and day trading side of it. You've seen tons of information all across the internet since 2020, especially about day trading. Most of you have probably heard of or seen the GameStop and AMC runs, and that's what's piqued your interest in this, or some flashy posts on Twitter of people making a lot of money. And that is possible to do that. However, what those people forget to tell you is that they have tons of years of experience in doing this. Also, it doesn't always work out that way. A lot of times those are lucky trades that went really well for them, and congratulations to them. But it sets a bad mindset and a bad initial thinking for you guys as new traders, because that doesn't happen your first day. It takes years. I've been doing this for over 6 years, and I still learn stuff every single day. And you can ask traders who have been doing this for 20 plus years. They're still learning stuff every day. It's an ever-evolving market, and conditions and times change. So it's not an easy thing to do. It's going to take time. It's going to take hard work, but you can get there. It's not impossible by any means. So What is day trading? A simple definition is going to be a speculative trading style that involves the opening and closing of positions within the same day. So if you open a new position, and by position I mean buying shares of stock, say 9 o'clock in the morning, and close the position by selling those shares by noon on the same day, then you've completed a day trade. A day trade is any type of trade that is done and completed within the same day of market hours, being 9:30 a.m. Eastern to 4 p.m. Eastern. If you were to hold it to the next day, that's no longer considered a day trade. Now, day traders typically use technical analysis and a trading strategy behind it to make these types of profits that you will see on social media in a very short period of time. Additionally, day traders are going to often use margin, which is borrowed money or a loan from their broker to increase buying power, which we'll get into later. So how does this all work? Long story short, day trading works by taking advantage of short-term price movements in a stock through active buying and selling of shares. So for those of you who have been on the agent's live streams, whenever he's trading in the morning, his famous market morning show, that's what he's doing. He's taking advantage of high volatility and high volume stocks that are low in price and day trading those to capture big moves with big share size, and that's how he makes its profit. So he's going out and seeking volatility in the short-term movements, and then the volatility creates opportunities for traders to profit from rapid buying and selling of stock. The more a stock price moves up or down, the more profit a trader can make or lose in a single trade. So that's why it's very important as new traders to exercise strong risk management and to keep the trades that go against you small and the winning trades that you have large. So it all comes down to a risk reward standpoint and probabilities. So as a day trader, your number one goal isn't to make profit. It's to manage risk. By managing risk, you're going to protect the capital, and the byproduct of doing this is going to allow you to make more and more profit over time. That's why a lot of day traders fail, is because they don't understand how to manage risk and mitigate their losses. So as you get more experienced as you're trading, you're going to develop a strategy and come up with predetermined entry and exit points before you ever begin to take a position in a trade. And that is going to be one of the most important things you do, is having a defined and set place of where you want to take a trade based on a particular setup, especially if you're trading intraday. So the forethought and planning helps take emotion out of the trade, which is going to reduce the chance that you're going to make mistakes and overmanage the position. So managing risk and emotion, keep those in the back of your mind. Now, before you start trading, you need to have a pretty well-rounded foundation beneath you before you hop into it. So all of us, you can ask any one of the head traders in here who's been doing this for a while, paper trade. You've got to paper trade before you throw in real money. Otherwise, it's going to go really, really badly. Day trading is extremely difficult, and you have to be very competent, knowledgeable to get good at it, and it's going to take a while. So look at day trading as being a doctor or playing a professional sport. It takes years to do it, but at the end, it's worth it. So your ability to make money in the markets is based 100% on your ability to perform day in and day out consistently, and by continuing to learn and grow. Attempting to day trade without any sort of training or education is going to go horribly wrong. Excuse me. So reading books, watching videos is going to be the first steps that any of you guys can take, whether it's from learning the terminology and technical analysis to fundamental analysis, however you want to go about it. The process of gaining knowledge is everything, but it's important to remember that just because you read a book on, say, how to fight doesn't mean you're ready to get into the ring. And one of the challenges with learning to trade is the overwhelming amount of information that you have to learn from all various of different sources that are all going to contradict each other. And everyone has their different way of teaching because they've all gone down different paths and started at different times, know some things that others don't, and the others know things that they don't. So the best advice I can say is pick one strategy and stick with it. If you are 2 years into your trading journey, but you've bounced around through 6 different trading strategies, you really haven't been in the market for 2 years. You've been in the market for maybe 3 to 4 because you keep bouncing around with strategies. So you have to find what strategy works for you. And it's going to be daunting. It's going to be horrible. And it's going to take a lot of time. It's going to be very frustrating. But you'll figure it out and you'll find one. Everyone does. That's why we say to paper trade. So you're able to go in, test these things out, and figure out what works for you before you start throwing in real money. So developing a profitable trading strategy, you can develop one on your own. That's going to take a very long time, most likely. Best bet is to find someone else that already does have a profitable trading strategy. Money, do we still have the strategies in the
in the strategy section? Yeah, they're gonna be available until Sunday evening.
Okay. If you want to go ahead and drop the text channel in the classroom text so people can see that real quick. Thank you. So those are I think there's 2 strategies in there? 2, 3?
Yeah, there's multiple strategies in there.
Okay. Anyways, there's 2 or 3. Yeah, 2 or 3, maybe 4, whatever. Oh wow, there's a lot more. Okay, I lied. I didn't scroll up far enough. So there's a couple strategies in there that profitable traders on our team are using. Highly recommend checking those out. Take all 4 of them. Start playing with it in the simulator and start figuring out what works for you. It's going to take time. It really is. You just are going to have to bear with it. So now, what do you do? Or have you edited the paper trade video yet?
Yes, but that won't be available until Monday.
Okay. Whenever you do get past the paper trading side and you go to a real live account with real money, take it slow. Also, side note here, when you're paper trading, if you're able to set your account balance to whatever you're going to deposit in your real money account, you don't need to be trying to paper trade with $100,000 or $1 million whenever you're only going to be depositing $5,000 into your account. It's going to change the scope of everything and set unrealistic expectations for yourself. On $1 million, it's not very hard to make $10,000 in a day. On 2,000, it's very hard to make $10,000 in a day. So set your account value to whatever you're going to deposit in the market or into your active trading account and trade based on that. It's going to set more realistic expectations for yourself, and it's going to help the mental and psychological side of trading whenever you switch over to that. So I'll expand on that a little bit here as far as how much you need to trade. Ideally, I'd say $2,000, truthfully, if it were me starting. You can get away with 1,000. Anything below that, it's going to be very tricky and you're not giving yourself much leeway. Now, of course, I know not everyone has $2,000 or $1,000 to throw in. And if you don't, that's fine. We all have to start somewhere and that's fine. Now, what I will say to that though, is don't expect to make a lot of profit. Look at things as a percentage value. So if you have a $500 account and you make $5 in a day, that's 1% of the account value. That's not bad for a day. While it may seem like a small dollar amount, that's fine, and it is a small dollar amount. What you're going for in the beginning is consistency and hitting nice solid wins day in, day out. If you started with $1,000 account and you made 1% a day for, compounded over 5 years, I believe it is, you would own North America. So getting good and consistent at 1% a day is really good. So while it may be discouraging in the beginning, the account will build, the account will grow. Promise, it just takes time. When you are setting up your account, I want to talk about the difference between cash and margin. So day trading with a cash account means that you are only using the cash that you have in your account. With a margin account, you have the option to use leverage, which is what's called margin. And what that does is it increases your buying power by borrowing funds from your broker, allowing you to use borrowed money to go in and place trades. This can be a very good thing, but it can also be a very bad thing. So whenever you're starting out for the first time, truthfully, I recommend starting on a cash account just until you get the basics down, because the last thing you want to do is be taking a loan from your broker to trade and a trade go against you, and now you have money that you've lost and you can't pay back. Now, with a cash account, you can day trade as much as you want as long as your funds are settled. So whenever you take a trade, the cash goes out because you bought the stock. Whenever you sell it, you get the cash back. However, in a cash account, that money, think of it like you sent a wire transfer or an ACH transfer. It takes time for that money to settle back into the account. Your cash account that you have at the broker is just a bank account. It's a money market account. It just holds the money. But you have to think that there's all these transactions of money going around between brokers and other traders and so on and so forth. It takes time for this money to come back and settle. So with the cash account, though, to make it clear, you are able to day trade as much as you want as long as the cash is settled. And usually that takes 2 days after you've sold. Now, pattern day trader rules apply in what we call a margin account. And what that means is you're only allowed to place 3 day trades within 5 business days whenever your account is below 25,000. Margin settles instantly. So as soon as you sell a stock, the money is instantly settled into your account, which means it's immediately available for withdrawal, but you are limited on how many trades, day trades you can take. If you're making trades overnight, then you're okay. But you are limited to 3 day trades whenever you are on a margin account if you're below 25,000. So kind of keep that in mind, the difference between a cash account and a margin account whenever choosing which account to go with. If you're just starting, I would start with a cash account and make your life a lot easier. So do we have any? I'll pause here just for a quick second. I know I've said a lot. Is there any questions up to this point? We'll get to patterns here in a little bit. You know what? Actually, let's just... Okay, recording's working. Sorry, the recording broke. So we can switch over to candlesticks and pattern trading. Is that something that's gonna help you guys out more? Okay, we'll go ahead and switch over and just speed up this process. So let me Let me share my screen. All right, I am sharing my screen now. People should be able to join. I think all of you should. Yeah, we don't have over 50 people in here. So I'll give everyone a couple seconds here to hop in. So these, actually, let me just make this easier. Let's make it one big screen. There we go. All right, so these are what we call candlesticks. Now, as the name suggests, a candlestick pattern is formed by just one candle. So the trading signal that you guys are thinking of and that you've heard of is based on one day's trading action. The trades based on a single candlestick pattern can be extremely profitable, such as these two candles here, or mainly this one. This candle is a lot larger than this candle back here, so you had a lot more profit potential to be made within this candle than this candle, and even the previous candles. This is actually a very good example of a setup. So understanding candlestick patterns, especially as a new trader, is going to help dramatically in giving yourself an edge in the markets. And whenever you are able to start identifying these certain patterns and certain setups within the marketplace, it can be very, very, very profitable. Now, the length of the candle while trading based on candlestick patterns is something that you really have to pay attention to. The length is going to signify the range for either the day, week, or the time period. So currently we're on the 5-minute time frame here. So each of these candle lengths are telling us how much movement was done in a price range for that 5-minute period. So you can see here on the right, we have the price of the underline here. So you can see, say on this candle, it went from 38.64 to a high of 38.78. That's a lot bigger movement than, say, this candle, which went from 38.65 and 38.60. So a lot more substantial movement within this one than this one. Now, so my charts are different. I'm colorblind, so I have to change my colors. Normally, on most of your charts, these yellow candles here are going to be red, and these blue ones are going to be green. Red is going to mean bearish, or it's declining in value. Blue or green is going to mean bullish and increasing in value. Bullish means going up, bearish means going down. So how do I want to explain candlesticks? So there's something called the, I don't even know how to say the word, it's a Japanese word, Marubozu candlestick, the best I'm going to get. And what it means in Japanese is bald. So context and terminology, we'll get to that maybe. But there's 3 important rules pertaining to candlesticks. There's buy strength and sell weakness, being flexible with the patterns, verify and quantify, and look for prior trend. That type of candlestick is the only candlestick which violates rule number 3, which is looking for a prior trend. I'll run through those rules again for those of you taking notes. Rule number 1, buy strength and sell weakness. Number 2, be flexible with patterns, verify and quantify. And then 3, look for prior trend. Now, the textbook definition for a Marubozu candlestick is one with no upper and lower shadow, therefore appearing bald. So let me see if I can. Not able to find an example here, but imagine it didn't have the wicks up here. So this is close. So it's pretty much the entire thing. And the upper and lower shadow in the bullish candle, so being here, implies that the low is equal to the open and the high is equal to the close. So you can see here, let me make it a little larger. So the open of this candle here was very, very close to the low that we had here. And then the close is very close to the high. Ideally, this is perfect, perfectly touching, but it's the market. Nothing's ever perfect. Now, the expectation is that with the sentiment, there's a surge of bullishness, and the bullish sentiment will continue over the next few trading minutes or trading sessions, depending on what time frame you're looking at. So in this example, a trader should look at buying opportunities with the occurrence of this bullish signal, and the buy price again should be around the closing price of that type of candle. So let me actually pull this up here. This might make it easier. Should have just done this from the beginning. Okay, can you guys see that? Just type a 1 or yes in the chat if you can see that. Yep, okay, cool. So this is a pretty perfect example of that type of candle. So it doesn't have a visible upper and lower shadow. There's a little bit of a wick, but it's pretty much perfect. So the open down here is at 971 with a high of 1030, low of 970, and a close at 1028. So it's doing all right. So open equals low for the definition. So definition of Marubozu, open equals low and high equals close. However, in reality, there's minor variation in this definition. The variation in price is not much when measured in percentage terms. So the variation between high and close is 1.8 but whenever you make that a percentage, it's just 0.17, 0.18. And this is where that second rule we had talked about applies. Be flexible, quantify, and verify. With this occurrence of this candle, the expectation has turned bullish, and one would be a buyer of this stock. Of course, at the time, you wouldn't have this data here, but when you see something like this, it's a pretty good indication that market sentiment has switched. Huge sell-off here, consolidation in here, and then a nice exploding candle changing the sentiment of the equity. Now, with this specific example in mind, the trade setup would be as follows. So your buy price is going to be right around this 1030, 1028, 1030 mark here. And your stop loss is going to be at about 970. So candlestick patterns don't give us a target. That's the downside. Now, we'll address this setting targets here in a little bit, but right now, just know that candlesticks don't set a target for you to hit. And what I mean by target is a target to sell. So there's no information that we can gather out of this single candle here that's going to tell us or give us a type of idea of when we should be selling, whether it's here. This candle gives us no information. Now, having decided to buy the stock, when do we actually buy it? And that's going to depend on your risk appetite. So this goes back to the strategy you've developed. Now, let's assume that we have two types of traders in here. Split the room 50-50, and one half of the room is the risk takers, and the other side of the room is the risk adverse. The risk adverse would buy on this exact same day as this candle is being formed. However, you're still going to need to validate the occurrence of this candle. And validating is quite simple. The market closes at 4 p.m. Eastern, so around 3:50, the risk taker trader is going to need to check if the current market price is approximately equal to the high price for the day, and the opening price of the day is approximately equal to the low price of the day. If this condition is satisfied, then you know the day is forming this candle pattern, and therefore you can buy the stock around the closing price. It's also important to note that the risk taker is buying on a bullish or blue candle, thereby following rule 1, i.e. buy on strength and sell on weakness. The risk taker, or the risk adverse trader is going to buy the stock the next day. So this candle has formed. They've now got confirmation. They don't want to, buy into this too early and have it go against them. That's just their risk tolerance, and that's okay. So what they're going to be doing is looking for this day, the day following. Now, before that, the risk adverse trader takes the position and buys, they need to ensure that the day is bullish to comply with rule number 1. Being risk adverse buyer can buy the stock only around the close of the day. So if the market opens, so this was the close here. If the market opens here and instantly goes up to here, they won't be able to buy it. However, the market opened a little bit lower, so right around there, just below the close. And the disadvantage of buying the next day is that the buy price is either way above or way below the suggested buy price, and therefore the stop loss is quite deep. However, as a trade-off, the risk adverse trader is buying only after doubly confirming that the bullishness is indeed established. So, the risk on trader went ahead and got in preemptively and took on more risk of not knowing what's going to happen the same day. They only had one level of confirmation, but because they're taking on that extra risk, the extra profit potential is greater for them. The risk adverse trader waited for double confirmation, minimizing their potential profit, but at least they had a better understanding of what was going on and how the trade may play out before they risked the capital. Yes, they may make less, but they also did wait for confirmation. Over the long run, is that going to help them? We don't know, but it's a good thing to consider whenever you're taking these different types of trades. So, of course, we see now that it's post trade, whether you took it here or whether you took it here, it worked out. Let me pull this one up here. So this is another example of taking the trade here, whether the risk on trader or the risk off trader would have both been profitable. Let me grab this one. This, however, is an example of where the risk adverse trader would have benefited from not taking the trade. So you had the same type of candle pattern form. The risk on trader probably would have taken this trade because it satisfied their first layer of conditions. So they're going to go ahead and take this trade. However, of course, as we can see, the following day, it didn't exactly play out. So in this example here, the risk on trader is going to lose, and the risk adverse trader who waited for some more confirmation made out and didn't take this trade, didn't lose capital. Now, notice here that this has been encircled. The risk taker would have initiated it, and then the risk off trader would have waited because they waited for that second layer of confirmation. So let's go ahead and talk about the stop loss on this bullish candle type. So what if after buying this candle, or buying on this candle, the market reverses its direction and the trade goes wrong? Like I mentioned earlier, candlestick patterns come with an built-in risk management mechanism. So in the case of the bullish Marubozu, the low of the stock, being here, acts as the built-in stop loss. So you initiate a buy trade, and in case the market moves the opposite direction, you should exit the stock or your trade if the price breaches below this candle. So this candle here qualified both as a buy for both the risk adverse and the risk taker. The open is 960, high is 988, low is 959, and the close is 988. So it meets the conditions. But the pattern eventually failed, and one would have booked a loss. The stop loss for this trade is going to be that low of the candle, i.e. the 959. Now, want you all to know that booking a loss is part of the game. Every seasoned trader goes through this. However, the best part of following the candlestick is that the losses are not allowed to run indefinitely. This is also why it's important to stick to your rules and don't break them. If it comes down here and it's getting close, it really truly broke on this day, if you are going to hope that it comes back with nothing else, validating your thesis on why it may come back, these types of trades here are going to happen. Ask anyone in here. This will happen to you. You have to stick to your rules. Ask Jaya how many times he's broken his rules and it screwed him up. He'll be happy to tell you. It might make him cry a little bit. He'll tell you. It happened quite a lot for a very long time. Now, of course, there's going to be instances where the stop loss gets triggered and you pull out of the trade, but the stock could reverse in direction and start going up. And that's going to mess with your head so much more than you understand right now. But a piece of advice I can give you is don't let it do that to you. Is that going to happen? No. You're going to freak out for a while, and it's going to make you upset. It's going to make you mad. Try to not let it affect you. Otherwise, it's going to compound for the rest of the day. It may compound in the next day or the next week, and then you're going to be on a downward spiral for a very long time. It's going to be hard to pull you out. So we're at our about 35-minute mark on the introduction to what the types of accounts are, and very broad base what is a day trader, and we've gone ahead and gone into this bullish candlestick pattern. So are you not looking? Oh man, I didn't switch over to the other. Well, I'm so sorry. I didn't switch over to the other picture. This was the picture I was talking about that entire time. I apologize for that. Money, Jaya, you guys got to speak up if it's not making sense. So I'll go ahead and reiterate what I was saying before. So, you got the confirmation here, and then the trade went against you. You have to stop loss out and cut the loss whenever it gets here. Otherwise, this trade is going to end like this, and it will happen to you over and over again. You can ask anyone, like I was saying, ask anyone in here, this will happen to you. So stop loss set here, you stop loss out here, you move on. There's going to be times where, am I able to draw? Yeah, cool. There are going to be times where the trade does come back up and go like that. And that's fine. It's not the biggest deal in the world. You stuck to your rules and you're managing your risk. That's what matters. And so, sorry about that again. I didn't realize I wasn't sharing this specific screen. So, what we're going to do, been going for about 35 minutes here, covering three small separate topics. we are going to throw you all with about 2 other people into your own rooms. Everyone's going to unmute and talk, and you guys are going to discuss the topics that we went over. You may understand it, you may not. That's totally fine. Doesn't matter. The more you guys kind of work on this, like it's homework of sorts, it's going to help you understand. So the best way to learn is to actually kind of teach it to others, in a sense. So, Jay, Money, you guys here?
Yes, sir.
Yep.
All right. Just help me out here. So we're going to move you all into your own breakout room. We're going to give you guys like 10, 15 minutes or so to kind of go over the concepts and the topics that that I just went over. And then from there, we'll regroup and we can dive into the next section. Sound good? Okay. So do we all have a basic understanding and concept of what we just for like the past 30, 40 minutes? Are we all good on that? Did the breakout rooms help? That's the main thing I want to know. Did they actually help? Okay, cool. So we can keep doing those. Perfect. That's what I like to hear. Okay, so let's go ahead and flip over to the bearish side of the concept that we were just talking about. So previously we went over the bullish side of things, which is to the upside. Now we're going to switch to the opposite, which is the downside. Let me just share. I won't have that issue of flipping between. And then you guys can see the 1,001 tabs I have open. Alrighty. So let me make sure I'm recording again. All right, recording. All right. So the bearish Marubozu is going to indicate extreme bearishness. So here's something. I know it's hard to see. I know it's pixelated. Just suffer with me. Be all right. So open is the high, and close equals low. So this type of candle pattern indicates that there's so much selling pressure in the stock that the market participants actually sold at every price point during the day. So much so that the stock closed near its low point of the day. It doesn't matter what the prior trend has been. The action on this candle during this time period suggests that sentiment has changed and the stock is now bearish. Let me see if I can probably find one recently on the market itself. Yeah, so days like these. Actually, that didn't open very well. Nope. All right, we're sticking with the example. So the expectation whenever you see this type of candle pattern is that the sudden change in the sentiment is going to be carried forward over the next few trading sessions, and you're going to want to look at shorting opportunities, which you have to be on margin to do, or if you're not on margin and you're an option trader, what you're going to be looking for is to buy puts on here. So the sell price or the price point at which you're going to want to buy the option is going to be around the closing price of this candle. So right around this area. Can I draw? Oh, that's ugly. Is this better? Yeah, somewhat. Right around this area. So, actually, can I make this a little better? No, it's not going to be better. Anyway, so in this example here, this candle right here, the encircled one, indicates the presence of this bearish setup. Now, notice that it doesn't have upper wicks and it doesn't have lower wicks, and those are also what we call shadows. I know I went over shadows, or I was speaking shadows, and you guys may not know what those are. Let me pull up a prettier chart so you're able to see shadows better. So let's use this candle here as an example. You have the high of the candle and you have the low. So the open and close here of the candle. This is what we call of the body. You have wicks, which are here. This is why it's called a candlestick, because you have wicks. The areas pertaining the wicks are what we call shadows. Just a very brief outline of that. Anyways, back to it. So on this one, we had an open of 355, a high of, it peaks out there, but we'll also a high of 355, a low of 341, and a close of 341. In real time and in a real example, you're going to have some little variation between the open, high, low, and close figures, which is okay, as long as it's within a reasonable limit. It's not a big deal if it's little wicks. You just don't want to have big wicks like these pointing out. So the trade on this would be to short or buy a put at when the price approximately hits 341, 342. So right down in here, I'm able to. So right around here, and then your stop loss is going to be right up here. So take the trade here, stop loss here. Now, this puts our stop loss at 355. And of course, at this stage, we still haven't dealt with setting targets, and we'll get there. So now remember, once this trade is initiated, you should hold on to it until either A, your target is hit, or the stop loss is breached. So once you enter the trade here, you're going to let this thing ride out as much as possible, or until any of your conditions as far as a take profit are set. If you don't take profit and the trade ends up doing one of these and going back up, what the hell just happened? Oops. All right. The trade goes up and it breaches the stop loss here that we had, then you're going to stop out at this point, and that's fine. But you want to have a profit target, somewhere, whether it be here, here, here. And again, we'll talk about that more here in a little bit. Now, the trade again is going to be initiated per your risk appetite of each individual trader. Like stated previously, the risk on trader is going to take that trade about 10 minutes before close on small amounts of validation, and then the risk adverse trader is going to wait until the next day. That's also going to ensure, again, that they comply with the first rule: buy strength, sell weakness. Let me also pull up this one. This one might be a little better to see the follow through. It's not so choppy. Okay, so this one shows again this bearish pattern circled here, and this is a pattern that wouldn't have, well, I guess in a bullish sense it would have worked out, but it would have worked out for both sides in this example. So let me move to where it gets interesting. So candles like this, these are the ones that are going to test you as a trader. This is what we call a trap. Now, a little bit ago, we discussed about the length of the candle, and one should avoid trading during an extremely small or below 1% range type of candle. So those are kind of your risk parameters. You want to see a well-developed candle. You don't want something that's just kind of small, minor, and weak. You really want to see that sentiment change, whether it's to the downside or the upside. A small candle such as this one, it's larger than these, but it's not larger than these here. So it's small comparative to the other types of candles that we can see on screen, whether it be here, 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 etc. So with it being small like that, it doesn't necessarily give us the confirmation of sediment change like something like this would do, where it is, one of the larger candles, except for back here. But this is a different example. Now, the problem with lengthy candles is also going to be about the placement of the stop loss. That's going to make the stop loss deep, and if the trade goes against you, the penalty, and the loss you may suffer is going to be painful. So, with that being said, you want to try and avoid taking these types of trades on a candle that's either super large or too short. Yeah, there's kind of a happy medium between the candles, and you're going to have to play with that to find out which types of candles are too long and too short for you with what you're trying to do. Now, to Money, should we go into should we go into like single ones, like spinning tops and whatnot?
Yeah, we could do that.
I'm just trying to think of what's going to be best for everyone here.
Yeah, let's do it.
All right. Let me go pull up some pictures here. I will wrap up this kind of little section here though. So, key takeaways. I'm actually going to go ahead and type these out. Number one, the rules are based on which candlesticks work for you. They're also based on what candlesticks work for the sediment. The Marubozu candle is the only pattern which is going to violate our rule number 3, i.e., look for prior trend. The reason for this is because it's a candle that indicates a shift in trend. Number 3, a bullish Marubozu indicates bullishness. So with that, buy around the closing price of it and keep the low of it as a stop loss. A bearish candle indicates bearishness, so you're going to want to sell around the closing price, and the high of the candle is going to be your stop loss. An aggressive trader can place the trade on the same day, whereas your risk-averse trader is going to place the trade on the next day, ensuring that it obeys our number 1 rule: buy strength, sell weakness. And then rule number 7 here, an abnormal candle should not be traded. Let me go ahead and kind of post that recap for your notes. There you go. There's those for you. Just side note to that, after 3, you see another 1 and 2. Those are, kind of like subcategories underneath that exact section. Discord doesn't let me do that like you can in Google Docs. Koala, is there somewhere possibly you can access these pictures? Yes, I can make these all available. That's fine. There's also going to be course releases in the future where all of you guys can have access to these and pick them up if you want.
Premium side.
Yep. On the premium side. Okay, so let's go into. Let me find this picture. There we go. All right, so this is another candlestick pattern. It's called a spinning top. So write down spinning top. That's what we're going to be talking about for the next few minutes here, and diving into some individual candlestick patterns and continuing on from the Marubozu. So a spinning top is actually a very interesting candlestick. Unlike the previous, it doesn't give the trader a trading signal with specific entry or an exit point. However, it does give us useful information with regard to the current situation in the market. And what this is going to allow you to do is position yourself accordingly based on what you're seeing. So this is an example of a spinning top. It looks just like this. Remember it, understand it, burn it into your brain. And two things with this are quite prominent. You'll see the candles have a small body, and the upper and lower candle wicks or shadows are pretty much equal. Now, let's have a quick little discussion in chat here. What do you think would have transpired or happened during the day that leads to the creation of this type of candle? On the face, the spinning top looks like a very, humble candle. It's, real small body. But in reality, there was some stuff that, took place during this day. So what do you guys think that may have happened to cause a, far down, far up, but really the open and close stayed relatively the same? Give you guys a second to think about that. If you want to post your response in chat, great, go ahead. If not, just think about it. So the small real body here, this indicates that the open price and close price are quite close to each other. So let's say this is the open at 210 and the close could be 213. Let's see if I can actually do this. 210. Oh, this is really bad. 213. Open, close. So in this situation, this led to the creation of a small real body because a 3-point move on a $200 stock isn't that much, and because the open and close points are nearby to each other, the color of the candle doesn't really matter, whether it's red or green. And what really matters in this situation is the fact that the open prices and close price are very close to each other. That's the main thing you want to take away. Now, the upper shadow connects the real body to the high point of the day. If it's a red candle, the high and the open are connected. If it's green, the high and close are connected. So high here, close here. Actually, let me change my color here. Get orange. So close, high. These are connected. Now, if you think about the real body in conjunction with the upper shadow, ignoring the bottom side of things, what does that tell us that happened? The presence of the upper shadow tells us that bulls did attempt to take the market higher or the stock higher. However, they weren't successful in doing so. If the bulls or the bullish side of things was successful, then the real body would have a long blue candle, and it would have filled this area and maybe came into here and closed here. But they didn't. They failed to drive it higher and keep it higher. So it's safe to assume that they tried and they failed. The lower side of it connects the body to the low. If it's a red candle, then it's here and here. So the same thing happened on the downside of things as the upside. The bears took control, or the bearishness sentiment of the market took control for a little bit, and they tried, but they weren't successful. If they were successful, again, like in the case of the bullish side, it would have made the candle body come down and close somewhere around here, but they weren't. So it stayed relatively within this range. Now, think about this candle as a whole, along with all of its components: real body, upper shadow, and lower shadow. It's all one thing to kind of keep in the back of your mind whenever thinking about it. The bulls made an attempt to take the market higher. The bears tried to take the markets lower. In either case, it didn't work. So this is why spinning tops can be very useful, because it's indicative of a market where indecision and uncertainty is starting to form. So if you look at a spinning top in isolation, it doesn't mean much. It just conveys indecision, as both bulls and bears were not able to influence the markets. Now, whenever you add it into an overall trend, it may work similarly to the last candle type we talked about, where it's, the market's either moving up for a while or down for a while, and now this candle is formed. Now everyone's kind of hesitant in the market and isn't sure if they want to either A, continue driving it higher, or B, continue driving it down. And there's this little game that the markets are going to play and do until someone can figure out who has control. Now, what happens if they occur when the stock is in a downtrend? In a downtrend, the bears are in absolute control, and they're managing to grind the prices lower. With a spinning top in the downtrend, the bears could be consolidating their position before resuming another, selling period, or the bulls have came in and started accumulating the shares that are being sold in an attempt to stop the price fall and, build up a position. If so, it really is a weird game, and I hope this is making sense. Does this make sense to some extent? Whether a little bit, none at all, does it make sense to some extent? Okay, Stalker, kind of. So maybe I'm overcomplicating it here. Think of this as an indecision. You have two sides to the market. You have buyers and you have sellers. Whenever you see this candle forming, it's an indecision between the buyers and sellers, and it's a struggle for power. So in markets, you have trends, whether it be up or down. Those are the most common two types of trends. Whenever you see something like this form, it's indecision in the trend, which can possibly be indicative of a trend change or something kind of going on that's not normal. We're no longer necessarily following the complete trend during this time period, and we need to be cautious and watching out for a trend change, and a flip is now possible. Does that make a little more sense? Okay, awesome. Excuse me. So, like I was saying, on the bearish side of things, either the market is going to have another round of selling, or it's going to change directions and price can increase. So this gives us some pretty nice setups potential to make some nice profits. So let's say if the trader has been waiting for an opportunity to get long on a stock, this could be their opportunity to do so on the bear side. Now, if they wanted to play it safe, they could test the waters and, I'm going to get a little bit into position sizing here, but say they wanted to take a position of 500 shares in a stock. If they want to kind of play the middle grounds of what we were talking about earlier between risk adverse and risk on, they can take a half position size. So 250 shares out of the 500 that they want. And they could wait and watch the market. If the market reverses direction and the prices start going up like they wanted them to do, they can go ahead and average up and take on a full position since they've waited for some more confirmation and things are going. If the price reverses and continues going, say, downwards, the trader would have already kind of bought at, the lowest, one of the lower prices of this trend. And since they only took half a position, they wouldn't have lost as much. So it's kind of a mediary way to test the waters and get the feet wet in a position before you go on, go 100% in on a trade. And it adds into the risk management side of things that we were talking about a little earlier. Let me pull up this one. Okay, so here on this chart, we have a downtrend. So here to here, we have an entire downtrend cycle. Right down in here, around the circle, you see spinning tops forming. So again, remember what spinning tops look like: small bodies, roughly equal size wicks on either side. So downtrend, we have small bodies. We have a couple of them actually, and wicks on either side. You can see here we had the bearish side of things. So equal sized wicks. I know it's hard to see, but it's there. Wicks, equal size, and a small bearish body. This is giving us an indication that the trend may change. There were a lot of buyers that came in around this level and decided to start buying for whatever reason it may be. So in this example here, of course, you can see that it took some time, but eventually it did go up. So the example of someone taking a half position and kind of playing the middle game of risk on versus risk off, would have added 250 shares somewhere during this time period. And then, maybe they waited up until this point of the trend to go ahead and take on a full position. Let me pull up this one. All right. So in this example here, you have a downtrend. You have a spinning top formation here. The trade did start to kind of work out, but you have a lot of spinning tops here. You have a lot of small bodies, a lot of large wicks surrounding those bodies and forming shadows over them, which is going to continue to show ongoing indecisiveness in this market. So think of a spinning top as a calm before the storm. The storm could be in the form of a continuation or a reversal of the trend. In which way the price will eventually move isn't certain. However, what is certain is the movement itself. And you need to be prepared for both situations whenever you're going through this. So we covered spinning tops in the downtrend, looking for those types of reversals. Let's go ahead and go with spinning tops in a bullish side of things. So pull this one up here. Okay, so an obvious observation here is the fact that there is an uptrend in the market indicated here. Price is moving up and up and up. And it implies that bulls have been in control over the last, few trading sessions or last few minutes, whatever time frame you're on. However, with the occurrence of the recent spinning tops here, the situation becomes kind of tricky. Now, there's one situation where the bulls are no longer in control. If they were, the spinning tops would not form on this chart like they are. 2, with the formation of the spinning tops, the bears have made an entry to the markets. Though not 100% successful at this time, the emphasis is on the fact that the bulls gave some leeway to the bears to come in and start shorting or selling, however that is looking within the markets. Now, the spinning top is going to convey indecision in the market. Neither the bulls nor bears have control. Placing the above fact in the context of an uptrend, we can conclude 2 things. 1, the bulls can be consolidating their positions before initiating another leg up. So, quick example, a trend like this is a downtrend. A trend like this is an uptrend, but we also have this other type of trend in the market, which is called consolidation. And that's where it just kind of chops around in a little bit of a range. Even tighter consolidation could be something like this. Now, the other side of the coin could be that the bulls are fatigued, and no, they're not actually consolidating. They're out of buying power. They can't drive it up. The price is too high, whatever it may be, and that could indicate some sort of correction coming around the corner. In either case, your chances of both these events on a standardized basis is going to be equal at 50-50. There's no true way to tell just based on this what's going to happen. Having said that, now what do you do? If the chances of both events playing out are equal, how are you going to take a stance? Are you going to go long or are you going to go short? In this situation, you prepare for both. Assume you bought the stock before the rally had started. This could be your chance to book some profit. So, say you bought here. This is a good time for you to take profits. It's moved up considerably since then. And taking profit never hurt anybody. Now, if you don't book profits on the entire quantity, assume that from our previous example, you had taken 500 shares on the trade. Same way how we were talking about buying 250 to start and then getting to that full 500 share position. In this case, assume that you already have the 500 shares and you did your scale in. What you could do in this situation is do the opposite of that. You can sell the 250 shares and take 50% of your position off the table, secure half of the profit potential there. If the shares continue to go up, awesome, great. If the share price continues to move down, like we see in this example, you booked half of your profit here up at the top, and you can make a decision to get out. Even if it comes all the way back down here, and you stop out at break even, you at least booked some profit up in this range. And that's very important to do as a trader. Taking profit, you never go broke taking profit. So there are two things, of course, that can happen after this, like I kind of just went over quickly. The bears do make an entry, and when this happens, the market starts to slide down, as we see in this example, and you book 50% of your profits. Other side, the bulls make an entry and it continues to move upwards, and at least you sold during some indecision and you still have shares to ride it up. It's not the worst thing in the world. Like I said, booking profits and taking profits is great. You'll never go broke doing it. It's really cool. You all should try it. It works. Let me pull up one of these. You have another example of something. So this chart here is going to be an example of an uptrend after the occurrence of a spinning top. So this is, like I was talking about earlier, you have your consolidation period where no one's really in control. It's indecisiveness. In the last example, we went ahead and broke down. In this example, it was just consolidation. Bulls were just kind of waiting, holding on their positions, and it eventually, of course, moved back up. So those are the kind of two scenarios that can happen. And to kind of sum this up, the spinning top candle shows confusion and indecision in the market with a equal probability, 50-50, of reversal or continuation. Until the situation becomes clear, you have to be cautious and you have to minimize your risk exposure and be ready to act in either way. Okay? Good on that? Okay. So went over the bearish side of the previous candle and then went over both sides of a spinning top. Let me double check my notes here, make sure I'm not losing it here. Okay, so we went through the bearish Marubozu here in this session. We went through the trap of that trade. We went through then spinning tops on the bearish and bullish side. Okay, that's taken us about another 30-35 minutes. So let's go ahead and we'll do a shorter. We'll play it by ear. I'll set 15 minutes for the breakout rooms again. If we don't need the full 15 minutes, that's fine. Some of you have picked this up faster than others. Some of you may need that extra time. So what we'll do here is break out again for about another 15 minutes. If you don't need all the time, then we'll just go ahead and pop back in here and continue on. So, Money, do you want to start moving everyone into breakout rooms?
I can do.
Thanks, buddy.
I'm thinking we do just want to do 2 rooms.
Recording going again. All right, so let's move over into doji candles. They're very similar to spinning tops. Let me pull up the picture. Okay, so they are very similar to spinning tops, except that it doesn't have a real body at all. So see how, so you have 3 different examples here. You have completely flat, and then you have very, very small bodies. This meaning that the open and closing prices are equal. Now, dojis provide crucial information about market sentiments, and it's an important one to know. I actually have a whole trading strategy built around dojis, which I can share at a later date. Now, the classic definition of a doji suggests that the open price should be equal to the close price with virtually a non-existent real body. The upper and lower wicks can pretty well be of any length. It doesn't matter if they're super small or super large. However, keeping in mind the second rule that we talked about earlier, i.e. be flexible, verify, and quantify, even if there is a wafer thin, paper thin, however you want to think about it, body candle, that the candle can be considered as a doji. Obviously, the color of the candle doesn't matter in case of the super thin body, but what matters is the fact that the open and close prices are super close to each other. Now, dojis have similar implications as the spinning top. And whatever we had just talked about for the spinning tops does apply to these doji candles as well. In fact, more often than not, comparative to the spinning tops, the dojis and the spinning tops are going to appear in a cluster. So typically when you see a spinning top formation or a doji formation, you're going to see multiples of these 2 types, kind of coming together. So let me pull up this chart here. Boop. I know I say boop a lot, and the boops are important. I promise. So here's a chart where the doji appears after a healthy trend, and the market reverses and its direction changes and correlate. So, but here you see that spinning top formation. That's more of a doji, but you could make a case for both. But let's just call this candle here and this candle here a spinning top for the sake of discussion. So you have spinning tops and you have dojis all kind of forming in this area. And this is going to happen quite often. So this is a bearish pattern was followed by a doji that turned back into bullish after the consolidation and reversal change. Here, let me pull this one up. This one is after a market rally, or the bulls were in control. You had some dojis forming and some spinning tops forming, and the market ended up changing direction. So the next time you guys see either a spinning top or a doji individually or in a cluster, remember that there's indecision in the market. The market could swing either way, and you need to build a stance or trading strategy during that time period that's going to adapt to the expected movement in the market, whether that be up or down. Probably should have covered this before we broke out, but that's fine. But that's dojis. So you're going to see them, around spinning tops. You may see them stand alone, but it's going to be 50-50. So like I said, very similar to the spinning tops in most ways, and you're going to see them together. Understood? All good?
Yep.
Okay, perfect. Before we go on, I know Ryan, Mr. Bush, Stalker, Tyler, Zenrose. Are you guys understanding this? Or are you guys good?
Yeah, like if you see a cluster of spinning tops or dojis, it can mean the market's being indecisive, and it can change the course of it.
Okay, yep.
I'm understanding this really well. So dojis are basically the same as spinning tops, 50-50, right?
Yep.
All right, yeah.
Cool. Just want to make sure everyone's getting it. What one do I want to? Bonnie, I'm gonna reference you here for a second, or Jaya. Doesn't matter actually. As far as candlestick learning, did you guys go from these directly to hammers? Do you think that's the best route to go?
Yeah, hammers would definitely be.
Yeah, I agree. Hammers, I'd say, are one of the easier to learn too.
Yeah. I'm just trying to think of a path of progression.
No, I think that would be fine.
All right, cool. Hammers. Oh, please tell me I started recording again. Oh, I did. Awesome. Okay. Hammer candles. Also, you may find them referred to as a paper umbrella. Why it's named that, no idea. It looks like a hammer. So the hammer is a single candlestick pattern in which is going to help traders in setting up directional trades. The interpretation of a hammer candle changes based on where it appears on a chart. So a hammer consists of two trend reversal patterns, namely the hanging man and the hammer. The hanging man pattern is bearish and the hammer pattern is relatively bullish. A hammer is characterized by a long shadow, so being this part here. This is your shadow wick, with a small upper body here. Now, to separate them, because there's a bullish and a bearish side of this, meaning they're directional. So if it makes it easier for those of you who are taking notes, call it a paper umbrella, and then below that you're going to have a hammer and a hanging man. So if you're writing it down and taking notes, that's how I would write it down, and that's going to make everything that I'm about to say flow and be a lot easier to understand. So your paper umbrella appears at the bottom end of a downward rally, and that's what is called a hammer. If the paper umbrella appears at the top end of an uptrend rally, it's what we call the hanging man. To qualify a candle as either a hammer or hanging man, the length of the lower shadow should be at least twice the length of the real body. And this is what we would call and be known as shadow to real body ratio. So if we measure this out here and then do the thing, so this candle wick here is 2 times greater than the body here. Does that make sense as far as definitions?
Yes, sir.
Perfect. Let me actually put this in chat just so you guys are able to have this as a note. Boop. There you go. There's that note for you, for those of you who missed it. Now, let's say this candle has an open. This is too. Let's say this has an open of 100, a close of 103, and then a low down here, the 94. Yeah, we'll call this, actually, let me make this an H. So a high of 103 and a close of 102. Sure, we'll go with that. So this is, in this example here, we have a bullish candle. It's a little better. So the real body close minus open, i.e. 102. So we're here and here. That gives us 2. And the length of the lower shadow, so our open, so it's going to be our 100 minus 94 is 6. So based on our rules of what makes this candle the specific candle, we can conclude that this candle pattern has formed, since based on our definition, the lower end range here is twice as long or greater than the low. Now, the bullish hammer is a significant candlestick pattern that occurs at the bottom of the trend. The hammer consists of a small real body at the upper end of the trading range with a long lower shadow. The longer the lower shadow, the more bullish the pattern. Let me pull this up here. So example be here. Okay, so in both cases here, we had trend and we had trend. Now, post both of these, it created a market reversal. So notice the blue hammer has a very tiny upper shadow. Oops, I don't know why I did that. Very tiny upper shadow, which is acceptable because, market isn't perfect. It's not always going to print perfect candles. So rule number 2, be flexible, quantify and verify. A hammer can be any color, as it doesn't really matter as long as it qualifies the shadow to real body ratio, 2-1. However, it is slightly more confirming to, in this example, see a blue body, because it implies that the momentum is starting to shift to the uptrend or the upside. Now, the prior trend for the hammer should be a downtrend. The prior trend is highlighted with this curved line here and here. The thought process behind a hammer in both of these instances is as follows. The market is in a downtrend where the bears are in absolute control. Again, indicated here and indicated here. Now, during a downtrend, every day the market would open lower compared to the previous day's close, and again, close lower to form a new low. This concept is called lower lows, and then the opposite side is called higher highs. We'll get there later. On the day the hammer pattern forms, the market is expected, and it does, in this example, trade lower and makes a new low. However, at the low point, there's some amount of buying interest that emerges, which pushes the price slightly higher to the extent that the stock closes near the high point of the day, being here and here. This action by the bulls has the potential to change the sentiment of the stock, and hence one should look at buying opportunities, whether it's going long the stock or buying calls. Now, this trade setup is going to, bear with me, this is going to be a lot, but this is how this trade setup works. A hammer formation suggests a long trade. The trader's entry time is always going to depend on the risk appetite. If the trader is a risk taker, you can buy again the same day or same minute. Now, remember, the color of the body doesn't matter, so there's no violation of rule number 1. If the trader is risk adverse, they can buy the stock the day after the pattern is formed, only ensuring that the day is a blue candle day. Now, open and close should be almost the same, within a 1 to 2% range. Lower shadow length should be twice the length of the real body. If both these conditions are met, then the pattern is a hammer and the risk taker can go long. The risk adverse trader should evaluate the open, high, low, and close data on the second if it's a blue candle. The trade is valid, and then you can go long from there. So let me pull up this one. Might be, yeah, okay. So this one's a better example. So the low of the hammer is going to act as your stop loss for this trade. So this chart shows the formation of a hammer candle where both the risk taker and the risk adverse trader would have had a setup for a profitable trade. Now, the trade setup is going to be like this. So your buy price for the risk on person is going to take it on, say, the hammer itself. So they may take it right about here. Buy price for the risk adverse trader is they're going to take the trade on this next candle, so maybe right about here, after evaluating the entire side of the candle and waiting for a bit more confirmation. Now, stop loss for both of these traders is going to be the same. It's going to be down here. So this is why there's pros and cons to doing both sides of this. Let me show an example again of where the risk adverse side of things kind of wins on this. So in this example here, the risk on trader takes this trade here up to the long side. You have your candle formation here, indicative of getting long. However, the risk adverse trader decided to wait and see how the next candle formed out. In this example, the trade went against the risk on trader, so that risk on trader lost money, whereas the risk adverse trader in this example would have benefited by just waiting for the buy strength and sell weakness rule, because the risk off trader would have waited for a candle to form somewhat like this to go and take their trade. So they lucked out in the situation by waiting for confirmation, where the risk on trader lost money. Let me see. Is this a good? Yeah, that'll work. So both hammers on this chart here qualified on the preconditions of a hammer. Prior trend to be a downtrend, shadow to real hammer body ratio. So on the first hammer, the risk adverse trader would have saved themselves from a loss making the trade thanks to rule number 1 of candlesticks. However, the second hammer would have enticed both the risk adverse and the risk taker to take the trade. So this one, the risk adverse trader would have lucked out, but on something like this, both of them would have been satisfied for their conditions. Risk on and risk off would have both been in here. And still, the trade didn't 100% work out in their favor. So please remember to not break your rules when you're setting your trade strategy. Once you initiate the trade, stay in until the stop loss or your target is reached. You shouldn't tweak the trade when starting out until one of these events occur. The loss in this first hammer, it's going to be inevitable. The important concept to remember in all of this is that it's a calculated risk opposed to it being speculative. You're backing your trade up with information and data given to you to give yourself a better chance at seeing profit, opposed to just buying on some random candle throughout here. You're waiting for that setup. That's a better. So this one. So this is a chart where the perfect hammer ends up appearing, but it doesn't satisfy the prior trend condition, and it's not a defined pattern. There's no real trend coming into it. Yeah, I mean, you have some trend here, but then there's some no trade days here, and then it bounces down, consolidates, then forms a hammer, but there's no trend. You just have an area of consolidation around this hammer, opposed to there actually being some downward trend coming into here, or some upward trend coming into here. So if you see things like this, where it's just pure consolidation leading up to here, with a bunch of crap before it, whether it be from a downtrend or an uptrend, just remember that this isn't a defined pattern, and you can get trapped in something like this. Now, so that covers our hammer side of things. Let's go ahead and hop to the hanging man. So if a paper umbrella appears at the top of a trend, it's called a hanging man. The bearish hanging man is a single candlestick and a top reversal pattern. Let me screenshot. There we go. So the hanging man is classified as a hanging man only if it's preceded by an uptrend. Since the hanging man is seen after a high, the bearish hanging man pattern signals selling pressure. So uptrend, 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 hanging man, we're going to look to pull back. Now, a hanging man can be of any color. It doesn't really matter as long as it qualifies the shadow to body real ratio, aka 2-to-1, shadow to body. The prior trend for the hanging man should be an uptrend, as highlighted by the curve here we just talked about. So uptrend, 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 and then followed by the hanging man. So that satisfies those conditions there. The market is in an uptrend, so bulls are in control. The market is characterized by new highs and higher lows. The day the hanging man pattern appears, the bears have managed to make an entry. This is emphasized by a long lower shadow of the hanging man. The entry of the bears signifies that they are trying to break the stronghold of the bulls, and thus the hanging man makes a case for shorting the stock. And the trade setup is going to look like this. For the risk on, a short trade can be initiated the same day around closing price. The risk off, a short trade can be initiated at the close of the next day, making sure that the following day is a red candle. You can go that way. The method to validate the candle for the risk adverse and risk taker is exactly the same as the hammer pattern. Once the short has been initiated, the high of the candle works as a stop loss for the trade. So this is our hammer candle. The stop. So risk on trader takes it here. Risk off trader may take it here. In either case, stop loss is here. In either case. Let me pull this one up. All right, this is the last one I'm doing. I can feel my voice starting to go. So in this chart, you can see the hanging man formation formed, and the risk trader is going to initiate this short trade on the day that this pattern appears here. The risk adverse is going to initiate somewhere down in here. In either case, the trade would have been profitable for both risk types. Now, my experience with this kind of trade setup and trading strategy is, while both the hammer and the hanging man are valid candlestick patterns, my dependence on a hammer is little. Well, Yeah, I'd say my dependence on a hammer is a little more as opposed to a hanging man. Through my experience, there's been a lot more times where the hammer has worked out opposed to the hanging man. All else being equal, if there were two trading opportunities in the market, one based on a hammer and the other based on a hanging man, I would prefer, truthfully, to place my money on a hammer. The reason to do so is simply, like I said, based on my trading experience in both of these patterns. That's just what I've seen, and I've recognized more times than not, bulls are going to be in control of a market. That's the way a market works. Now, my only concern with a hanging man is the fact that if the bears were indeed influential during the day, why did the price go up after making a low? And that can kind of re-establish some bull supremacy in the market. So I would encourage you all to develop your own thesis based on observations that you make in the markets. And that's going to help you not only calibrate your trade more accurately, but also help you develop a structured market thinking and recognizing how these markets operate and how they move. So that covers those candlesticks. Let's go ahead and pop to a